June is almost here, Tyler, and we're ready to talk about a couple of stocks that look really compelling to buy right now.
As usual, you're going to do a pretty well-known company, and I'm going to send us way out into left field.
Yeah, that's you are, but it's the weird thing about it is you're talking about a bank and you're talking about a business and an industry that I'm the one that's usually talking about. And a year ago, you wouldn't have really come anywhere near. So definitely a lot of things are getting switched around, even though we're also talking our normal book.
It's Freaky Friday, even though we're recording on a Tuesday.
There you go. I guess we have to publish this on Friday now. So we'll see what happens. All right, so let's get to it. We got a couple great stock ideas to talk about. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. It's fool.com/unscripted. Go to that link. The Motley Fool is you can get access to The Motley Fool's 10 best stocks to buy right now. Again, it's fool.com/unscripted. We'll leave it on the screen. You can see it through the whole video. Get to the end of the video. You want to go check it out. Go check it out. All right, Tyler. So you're going to talk about an obscure business in a sector that I'm usually the one talking about. That's banking. You're going to bring a bank. I'm going to talk about a beaten down legacy apparel footwear manufacturer that is just down in the dumps, but I think there are some clear green shoots that they're about to turn the corner. How about you go first?
All right. So I'm going to go with, and like I said, really going out far into left field. This is the company is called North Point Bankshares. The ticker is NPB. This is a $460 million market cap bank that went public actually earlier this year. It's like any other bank, I guess you could say in that sort of sense. And you could say, oh, it's just like some small regional bank that's situated in Michigan. But here's why I think it's pretty unique. North Point Bankshares is also a digital bank that does most of its actual business online, mostly purchasing loans from other companies or owning loans from other banks that are originated in a model that's called an all-in-one mortgage. And this is a mortgage that combines you combine your conventional mortgage with what's called a sweep account and a home equity line of credit, all wrapped into a single loan. If you say, for example, you are taking out a HELOC, you'll notice that the interest rate is typically much, much higher than your traditional mortgage. This all-in-one mortgage product basically allows you, the homeowner, to tap the equity in your house at any given moment without like having to take out a second mortgage because it's built into your initial mortgage. It uses this sweep account function where the bank sweeps away any interest payments that are supposed to be made on this thing on the home to meet your obligations for the interest, but then leaves a principal in an account that allows you to draw on that such that you can use it for a home line of credit or something like that. It's ever so slightly higher than a traditional mortgage, but it's considerably less than a home equity line of credit or a second mortgage, therefore kind of netting out the savings. So people that want to tap lines of credit on their housing and things like that, it's a beneficial way of doing that.
The thing about it is it's a specialty product that's actually generally pretty safe for the lender. And it's advantageous for buyers of homes that when they acquire that home, or refinancers of homes who know that they have a line of sight to the need to tap that line of credit for whatever the reason may be.
Yeah, for home improvements, things like that. And it really addresses the thing that you and I have been talking about, like going back to our latter conversations with solar companies and residential solar, was when we were seeing home equity line of credit in the 8 to 9% range. It made basically doing that home improvement project practically uninvestable. But now if you bake it into your traditional mortgage with this product, it makes it a little bit more interesting. North Point Bankshares specializes in this all-in-one program where they either originate the loans themselves, they buy them from other banks that make this type of loan, and they also have a servicing business where, say, another bank other than North Point makes this loan, but doesn't service this particular type of loan because it has that sweep account and all these other bells and whistles to it. North Point actually has a services fee revenue where they will actually service these loans for those banks or for institutional investors when they start to bundle some of these all-in-one loan obligations off to other things. So it's got three ways that it can kind of work on this particular type of loan. The founder, Chuck Williams, he's the chairman and CEO. He's the founder. He's been in banking for like 30 years. He's built this business from scratch. Very much it was in the mortgage sort of business. The return on assets is 1.3%, pretty like average for a bank these days, 11% or 13% return on equity. And what makes it interesting to me is if you look up and down, I think like the credit metrics on it look pretty good. I think The balance sheet looks fine. There's no like egregious things in it aside from the fact that it's a really small bank. And the other thing that to cap it all off, you have this interesting bank in an interesting sort of sector, which I think will serve a niche that the market will receive relatively well. It's trading for less than book value and 7 times earnings. I think we're in a pretty tough housing market these days. And so like the amount of mortgages getting originated, it's pretty low. But yes, things could get worse from here, but I think this is a pretty low point in the mortgage business these days. And as a result, I think this is actually might be a pretty opportune time to buy innovative is maybe a word for this bank, innovative bank with a unique product trading at a discount to what you would get most banks for.
Yeah, when you can buy a bank for around 80% of tangible book value, especially, either something is very wrong or the market is just very down on a specific thing. In this case, it's their book, easily the most important part of their business. So that's the reason it's trading for this discount. Having just gone public, it's almost certainly not trouble, but it's small and it's niche. And when you're small in your niche and you're a bank, you're either wildly overvalued or potentially undervalued, depending on sentiment. And that's the case right there. So I think we could put this kind of maybe in the same cohort as Live Oak Bank, which is one that I follow that's deeply discounted right now, not to these rates. It trades for a tiny premium to book value, but it's a specialist just focusing on small businesses. So I think this is really compelling. Do your own due diligence, but I think it does look compelling. Tyler, you ready to go big?
Let's go big.
Wait, that was your opportunity to say, just do it.
Oh, let's do it. Just do it. Oh, I messed it up. Just leave it like that because that makes it better.
Even better. Even better. Okay. All right. Yeah. So just do it. That's Nike, right? Nike shareholders, man, have been on some kind of a journey. I'm going to share on the screen here. Nike stock. And sometimes you hear things like, man, this stock's been flat for 10 years. And Nike stock is, well, it's up about 22% over the past decades. That's like the kind of yields you could get on cash in recent years. So it has not been a big performer, but that ain't flat, Tyler. That ain't flat, right? This is more like a roller coaster. It's gone up some big hills, gone down, and well, we're basically back where we started. So what's happened with Nike and why with Nike with a stock basically about where you could have bought it back in 2018? Why are we talking about Nike right now? So let's talk about what's brought us here and why Nike stock is down so much. And the short version is it's a business that lost its way a little bit, went through some management changes a number of years ago. Management's focus was omni-channel, but mainly on trying to control the relationship with the customer and really building up its direct sales channel. As a result of that, the company lost its focus on the wholesale channel. And the wholesale channel is what we as consumers think of retail. They decided they really wanted to build their e-commerce platform, focus on their Nike branded stores, outlet stores, that sort of thing. And they built a good business, but turned their back on where the customers were, where the consumers were. And unless you were a very high-end luxury brand where people will go where you are, you got to be where the customers are. As a matter of fact, here's one of the things that they did. I think it was back in 2019, Nike stopped selling to Amazon. They stopped selling to Amazon because of concerns about bootleg products coming out of China. So they stopped selling directly to the fastest growing e-commerce retailer on earth. So an example of some of the missteps that the company made along the way. Phil Knight, by the way, is still chairman, 87-year-old Phil Knight, still the chairman. But Elliott Hill was a longtime Nike executive and has recently come back as CEO and has really revitalized the focus on retail channel to wholesalers. There's an agreement in place now to start selling on Amazon again. Dick's Sporting Goods CEO said some really favorable things about Nike and the importance of Nike and the strength of their relationship. And we have Dick's buying we have Dick's buying Foot Locker, which I think is going to be a positive for Nike as well. Foot Locker, probably half of their shoe sales are Nike, maybe more. So maintaining the strength of that relationship is really good. So I think what we have is a situation where, and again, not to anchor on the stock price because that's always really dangerous. We have a business that's on the cusp. This isn't a business that's struggling or in trouble. This is a business that needs to refocus and be in front of where its customers are, that is taking steps to do that. This is still one of the most valuable, most recognizable names in athletic apparel and footwear on a global basis. And it's trading for about 16 times cash flows. So a couple things about that. We're at a period where cash flows have been generally high, but they're starting to fall. So you put that together, and as they've worked, so all of this decline, Tyler, working through some inventory issues they had because of missteps they've made with their sales channels. They've worked through those things. Inventory levels are back to where management wants them to be. And you have a business trading for, as much as the stock is still at prices from back in 2018, you have a valuation on a cash flows basis that's the cheapest it's been in a decade. So is there some risk of a value trap here? Sure, there's some risk of a value trap. Is there a risk of a value trap here? Sure, there's some risk of that, because we do have a little bit of a turnaround that needs to happen. They need to deepen those relationships, get their products on Amazon in a much larger way. They're taking steps to do that, though. So there's some execution risk involved. But I think we're being compensated for that as investors at that mid-teens price to cash flows, with cash flows that are at levels that are well below where they should be. I think we're going to see cash flows and revenues are going to return back to growth. Margins are going to get better as they scale up their retail channels a little bit more and continue to develop innovative products and take back some of the market share they've given away. One of the other risks too is competition, right? We have Hoka's. We have On, we have Hoka. Those are brands that are taking market share and running. But if you think about basketball, you think about cleats, this is still a dominant brand. So I think there's a tremendous amount to like. Their apparel business is large. They're still growing outside of the US. So I think you put all of those things together, Tyler, and at 16 times trailing cash flows and cash flows that are going to start going back up again in the next year or two, I think there's a lot to like from Nike.